All right, welcome to another deep dive. This time, we're going to try to wrap our heads around the world of finance, banking, and money,
Yeah.
which I know is something that a lot of you out there have been asking about. You want to kind of understand how the system works a little better
Yeah, definitely.
and be a little bit more financially savvy. So we've got a great source for this PDF called Finance, Banking, and Money
Okay.
from LibreTexts, which is a collaborative platform for these open educational resources.
Sounds good.
So it covers a wide range of topics. It talks about, how money and banking and financial markets work, what they do,
Right.
what their roles are. It talks about things like monetary policy, the Federal Reserve, open market operations, and then, things like interest rates, how those work, the dynamics there, risk, the term structure. And then it talks about different financial instruments like bonds and equities and derivatives and financial innovations, regulation, even historical financial crises. So a lot to cover here. And I've got an expert with me to help me break this down and try to pull out some of the key takeaways and some of the most interesting insights.
Sounds good.
So are you ready to dive in?
Absolutely, yeah. It's an area that people often find kind of confusing, complex, and hard to understand.
Right.
But it's so important to grasp, especially if you want to, make informed financial decisions.
Okay, so let's jump right in then. One of the things that I found interesting in this source material was how it kind of pushes back on this stereotype of the, evil, brilliant financier.
Yeah.
These sort of masterminds who are manipulating the system for their own gain.
Yeah.
And it argues that actually most people who work in finance are, well, pretty normal people.
Yeah, I think that's...
it's not this sort of cabal of evil geniuses.
It's as nefarious as people think.
Right. So I'm curious, from your perspective, what really motivates people in this field then? If it's not just about, pure greed and profit, are there other factors at play?
I think so, yeah. I think while profit is certainly a motivator, I think a lot of people are drawn to finance because they like to problem solve.
Yeah.
They like to think about complex systems. They like to manage risk and kind of understand, how the global economy works. It's almost like a big puzzle, like trying to figure out how
That's an interesting way
all the pieces fit together.
to think about it.
Yeah. Can be really intellectually stimulating for some people.
Right. So it's not just about, sort of greed and avarice. It's also about the challenge
Exactly.
and the intellectual satisfaction.
Exactly.
Okay. Well, that makes sense.
Yeah.
And I think to really understand the world of finance, we need to understand, money itself.
Yeah, definitely.
I mean, we all know it's what we use to buy things, but I think this source does a really good job of reminding us that it's so much more than that. It's, it's a unit of account. It's a store of value. It's a standard of deferred payment.
Right.
It
underpins so many of the transactions that happen in economy.
Yeah. I mean, I think the example that really brought this home for me in the PDF was talking about gas stations. Imagine if every time you went to fill up your tank, you had to barter. Like,
it would be a nightmare.
I've got this, chicken. Will you give me some gas for it?
Yeah. Right.
No, I need a goat. Just
think that
the idea of having to barter for everything, it's just mind-boggling to think about how inefficient that would be.
Yeah, it's like taking a massive step back in time.
Right. And that's really what money does, is it just simplifies things tremendously. It makes transactions so much more efficient.
And the source is really interesting as well because it talks about how, even when traditional currencies collapse, people find other ways to create money.
Yeah, they were talking about...
Like the example of Argentina, where they had a currency crisis.
Right.
And they started using these creditos.
Yeah.
And it's remarkable because these things held value simply because communities accepted them in exchange for...
Right. It's like this...
goods and services.
Social contract, almost.
Yeah. It's really a testament to the fact that money is ultimately a social construct.
Yeah.
Its value doesn't necessarily reside in some glowing physical object.
When you think about it that way.
But rather in our collective belief in its worth.
Yeah. I mean, it makes you think about fiat money, like the U.S. dollar.
Yeah.
Which essentially is just a promise backed by the government.
Right. Exactly.
Its value rests entirely on our faith in that promise.
It's kind of like those clamshells they used to use for trade centuries ago.
Yeah. I mean, it's a little bit unsettling when you think about it that way.
Yeah, it does make you think about
right. It's like
the fragility of the system.
the whole system rests on this idea of trust, right?
Is crucial in any kind of functioning economy.
Exactly. All right. Well, speaking of trust, I think another key concept that this source material really drives home is this idea of the time value of money.
Okay, yeah.
Which, can be a little bit tricky to wrap your head around.
A bit of a...
But it's essentially this notion that money today is worth more than the same amount of money in the future.
Yes.
Because it has the potential to earn interest, right?
Exactly. You could think about it like planting a seed today.
Yeah.
It has the potential to grow into a tree over time.
Right.
Whereas if you plant it in a year's time, it's going to have less time to grow.
Right. So investing $1 today could yield you more than $1 tomorrow.
Exactly.
Assuming it's a wise investment.
Right. Okay.
Right. Okay. But how does that connect to concepts like interest rates and bond prices?
So this is where it gets interesting. Bond prices and interest rates have what we call an inverse relationship.
Okay.
As interest rates rise, bond prices fall, and vice versa.
Okay.
If you think about it, if new bonds are offering these higher interest rates, then the older bonds that have lower interest rates become less attractive, and so their prices decline.
So if I hold on to a bond while interest rates are going up, I could potentially lose money.
Okay.
Okay. That's something I need to...
It's really important to
keep in mind.
Understand these dynamics if you're going to navigate the world of finance.
Well, let's talk about bonds then a little bit more.
Okay.
I know the source material kind of breaks down the mechanics of bonds. It talks about things like coupon payments and face value and maturity and how to calculate the yield to maturity and all this stuff. But honestly, it all still sounds a bit like...
I can imagine.
Wall Street jargon to me.
Yeah.
Can you break it down in simpler terms? Like, what is a bond?
So a bond is essentially a loan that you give to either a company or a government.
Okay.
And they promise to pay you back the principal. Which is also known as the face value at a certain date, which is the maturity date.
Right.
And they'll also make regular interest payments.
Okay.
Which are known as coupon payments.
Got it.
Yeah.
So it's like a long-term investment with
Yeah, it could be.
predictable returns, assuming that interest rates don't go haywire and...
Unless interest rates go crazy and the value plummets.
The value of the bond plummets, right?
Exactly.
Okay. And then there's this thing called the yield curve.
Yes.
Which I've heard about, but I don't really understand.
So the yield curve is essentially a visual representation of the yields of bonds with different maturities.
Okay.
All issued by the same issuer. So, for example, the U.S. government.
Okay.
And it's really useful because it can tell us something about market expectations. Future interest rates.
So investors are looking at this yield curve.
Exactly.
Trying to kind of get insights into...
trying to gauge where they think interest rates are headed.
Interest rates are going, right.
Exactly. And they can also look at specific types of bonds, like Treasury Inflation Protected Securities, or TIP-ES, to get a sense of inflation expectations in the market as well.
Interesting. So it's not just about buying and selling pieces of paper. It's also a reflection of these broader...
It's like a window into market sentiment.
Economic expectations.
Yeah.
That's fascinating.
Yeah, absolutely.
So it makes me think about the stock market, and how those prices are determined. Is there a similar dynamic at play there?
The stock market is a bit different, but it's also a reflection of information and expectations.
Yeah.
The source dives into the concept of efficient markets, which is this idea that market prices already incorporate all available information. This is based on the theory of rational expectations, which basically says that investors make decisions based on all the information they have access to.
So if the market is efficient, does that mean it's impossible to consistently beat the market?
It's a very difficult thing to do.
Yeah.
Consistently beat the market.
Okay.
But, the concept of efficient markets is not without its critics.
Right.
The source points out that there are these things called market anomalies, which are these unexpected price movements that can't really be explained by rational expectations.
Right. So there's still room for smart investors.
So it suggests that the market may not always be perfectly efficient.
Right.
There might be some opportunities there.
Find those.
If your efficiency.
Right. And what are some examples of those anomalies? What kind of things?
So there are a few classic examples. Like the January effect.
Okay.
Where stock prices tend to rise in the first month of the year.
Okay.
Or the small firm effect.
Oh, okay.
Where smaller companies tend to outperform larger companies.
Interesting. So it's not just pure rationality.
And these kind of challenge the idea that all information is already fully reflected in prices.
So there's this element of
there might be human psychology.
Maybe irrational behavior that can still impact markets.
And the source also touches on behavioral finance, which is a whole field that explores how psychological biases can affect investor behavior.
Yeah. I mean, one classic example I always think of is this aversion to short selling.
Yeah.
You know, like
absolutely.
Most people, it just seems so counterintuitive.
Yeah. People don't like betting against things.
Like to bet against a stock.
They'd rather bet.
Hoping it will go down
on something going up.
Yeah.
Yeah. But, short selling can be
I've always found it a little confusing.
A profitable strategy.
Can you explain it just briefly?
Yeah. So basically what you're doing is you're borrowing shares of a stock.
Okay.
Selling them at the current price.
Oh.
And then hoping to buy them back later at a lower price to return to the lender.
Okay.
So your potential profit is the difference between the selling price and the buyback price.
Okay, so it's a risky strategy. But
yeah, it's risky, but it can be very rewarding.
Potentially big rewards.
If you get it right.
Right.
But, as I said, people don't like to do it, even if they think
counterintuitive,
the stock is going to go down.
Right, okay. Well, what about financial institutions?
Yeah.
Like banks.
Right.
Why do we need them?
So this is where
if markets can
the issue of asymmetric information comes in.
Okay.
Which is where one party to a transaction often has more information than the other party.
It's like these used car salesmen, right?
Exactly. Classic example.
Yeah.
And the source highlights two key challenges here. Adverse selection and moral hazard.
Okay.
Adverse selection occurs before the transaction. And this is where, lenders or insurers might attract riskier borrowers or people who are more likely to file a claim.
Right.
And then moral hazard is what happens after the transaction, where borrowers might take on riskier behavior after they've been given the loan or insurance policy.
So banks are basically acting as these gatekeepers.
Exactly.
Trying to...
They're information specialists.
Weed out the risky borrowers.
They screen applicants. Yeah. They monitor borrowers. They use their expertise to manage
the risk. Yeah, that the borrower behaves responsibly after they get the loan.
Exactly. Making sure that the money is going to its most productive uses and minimizing defaults and losses.
Yeah. So they're not just lending money. They're playing this crucial role.
They're a key part of the whole system.
Managing risk and information within the system, right?
Absolutely.
Okay. But with all this talk about risk, I'm curious about, how financial innovations impact the system. Do they make it more stable?
That's a very good question.
Less stable.
It's a tough one.
Yeah.
I think the source really focuses on how a lot of financial innovations are created in response to particular challenges. For example, like during the Great Inflation, there was a big need to manage interest rate risk.
Right.
And so this is where you saw innovations like adjustable rate mortgages and money market mutual funds and derivatives. All these things were designed to try and address specific financial needs.
So it's not that the innovations themselves are inherently good or bad.
Exactly.
They're just...
It depends how they're used.
Tools that can be used.
Yeah, who's using them?
Yeah, in different ways.
Exactly.
Right, depending on the context and people involved, right?
Yeah. Like any tool, you can use it for good or bad.
Yeah. And the PDF talks about this idea of loophole mining.
Yeah.
Which I thought was really interesting. Like, essentially,
this is where
financiers are finding...
You have financiers who are very creative.
Yeah.
They find ways to maximize their profits within the existing regulatory framework.
So they're not necessarily breaking the rules.
Not necessarily breaking the rules, but finding those gray areas.
Right, pushing the boundaries.
Exactly, where they can exploit the system for their own gain.
Trying to find those little loopholes.
Yeah.
Yeah, and I mean...
A classic example is money market mutual funds, which offered higher interest rates than traditional bank deposits, but also gave you check rating capabilities. So
like a constant...
it was a very popular innovation in the 70s and 80s.
Cat and mouse game almost, right?
Yeah.
Between the innovators and...
And it highlights this constant back and forth between innovators and regulators.
The regulators trying to...
Regulators always trying to catch up.
Yeah, close those loopholes as they emerge.
Exactly.
Which raises some interesting questions about...
It does raise interesting questions about...
how effective regulation can be.
Yeah, regulation and what...
the unintended consequences of financial...
The unintended consequences are of these innovations, right?
For sure.
Okay. Well, I think to understand this sort of dance between innovation and regulation, we need to understand
the structure and the evolution of the U.S. banking system itself.
Yeah, absolutely.
So maybe that's a good place to pick up in part 2.
Sounds good.
What do you say? You can take a quick break?
Yeah.
And come back and try to...
Let's take a break.
Yeah, unravel the complexities of the...
We'll come back to that.
U.S. banking system.
Yeah, sounds good.
All right, we'll be right back.
Okay.